Well, we are seeing strong data sending the 10-year toward a 16-year high again. We see the 10-year yield there up about at 4.82 right now. Investors remain concerned over pressures of potential rate hikes, the mortgage market, and the crisis panning out in the Middle East, all contributing to these swings. For more insight on the bond market, we're joined by Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Kathy, good to talk to you today. We're looking at 4.8% roughly for the 10-year. Are we going to continue to see this march towards 5%?
Well, it certainly looks like it at this stage of the game. It will depend on the data that we get, but the retail sales numbers suggest that, the upcoming GDP figures will be pretty strong. We already had a sense the third quarter would be pretty strong, but these numbers will contribute to it. So at this stage of the game, there is a risk that we go up to 5, even a little bit above that. Historically, in the past, cyclical peaks in the 10-year have come in pretty much at the peak rate of the Fed funds. So you kind of get the yield curve to converge at the peak. So there is still some upside risk, but we would say that at these yields, we find them pretty attractive, both in nominal terms and in real terms for investors looking for income.
And Kathy, as we look at the volatility, though, how is that informing your strategy here if you're someone who wants to invest in this space?
Yeah, volatility has been elevated, and it probably is going to continue to be because a lot of that has to do with uncertainty about the direction of policy. This dysfunction in Washington is not helping. You've got global issues, wars now that are contributing to that. And maybe a little bit of a thin market, or liquidity isn't what it used to be because people are kind of standing back and waiting to see what happens next. So I think that in a volatile environment, either a barbell strategy or a laddered strategy where you kind of spread out the maturities of your bonds and stay in high quality bonds is probably the best way to deal with it, because you can lock in some of that income stream, but you're not trying to target one yield one day of the week and just ride the ups and downs.
Yeah, that would be a very exhausting strategy day by day. Kathy, in many ways, the bond market's doing the job for the Fed. This is sort of where the Fed would like it to be given credit tightening. But seeing where rates have moved, how quickly they have moved up, has that changed your base case for the Fed's trajectory at all?
Well, this has been an unusual cycle. I mean, I would say this has been out of the ordinary in many ways, coming out of a pandemic, having supply side shocks, and then big fiscal stimulus, moving demand. Now we've got a bunch of geopolitical things happening. So I think the Fed, at least from what we're hearing, believes that it's done enough to slow the economy. There's usually about a 15 to 18 month lag between Fed rate hikes and the impact on the economy. And what we're hearing from the regional Fed presidents is they're talking to individuals and businesses, in their districts on the ground. And what those businesses are saying is, hey, you guys have done enough. Things are slowing down. We're starting to see some weakness. There's some concerns about commercial real estate and new orders for various types of durable goods and services. So I think what they're hearing is, this is probably a good point at which to stop and then let the tightening continue through the shrinking of the balance sheet and sort of a gradual slowdown. If there's any hope for a soft landing, they're going to have to back off a little bit and wait to see if the inflation numbers continue to trend lower.
So then the likelihood of getting to 2%, what sort of timeline are we looking at if the current trends continue?
Well, I would say it's another year or so out. Now, the interesting thing is if you look at the core PCE, which is the benchmark that the Fed has used, on a 3-month rate of return, rolling return basis, it's down to about 2.2%. So it's actually very close to the target. But that is, just a piece of the inflation measures that they look at. But I think that it's certainly doable in the next 12 months. I think the Fed's projections have it pushed out a little bit further than that, but it wouldn't surprise me if the core PCE actually gets there relatively quickly, because once the rents start to roll off, you'll see some of that pressure on the inflation numbers come down, and we should start to see some better supply-demand numbers easing some of that inflation pressure.
And certainly hoping we don't get any more surprises coming up throughout the rest of the year. A big thank you there to Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thank you so much.